Good afternoon, colleagues, and welcome to this research seminar, the presentation of UNCTAD's Trade and Development Report 2022. I'm Rick Sammons, Director of the Research Department here at the ILO, and it's really a great pleasure to welcome our UNCTAD colleagues here today to discuss their recently issued report, which is really quite a tour de force. So congratulations for that. We have with us as presenters, after which we'll have some Q&A and some discussion, Richard Kozul-Wright, who directs the Globalization Development Strategies part of UNCTAD, Anastasia Nesvetailova, head of the Macroeconomic and Development Policies branch at UNCTAD, and Jeronim Capaldo, Economic Affairs Officer, Global Affairs and Development Strategies at UNCTAD. So I don't want to take away from the time that you have, the three of you have, to elaborate on some of your findings and guidance in this regard, and I suspect it will meet with a lot of interest on the part of ILO colleagues and a wider community. So, Richard, over to you.
Thanks a lot, Rick, and thanks for the invitation. I'm just going to give some very general introductory remarks. I'm going to leave it for the people who did the hard work to explain some of the details of our argumentation. I should say from the outset, there's more to come with this TDR. We only launched the chapters that dealt explicitly with the global economy this year. We also have sections on regional development and regional options, and those will be coming out shortly, I hope. So there is more to come from this report. But the chapters that we launched obviously received a lot of attention, I don't think for the broad assessment of the state of the global economy. Like everybody else, we downgraded our growth performance for this year and expect to see a worsening of the global economy next year. And that's true across all regions of the global economy, and certainly the downside risks to growth next year are significant. And we, like everybody else, we continue to worry about the financial stability of the system, and there are some serious cracks in that. That's obviously true for many developing countries who are being squeezed on several fronts. Right now, the debt problem is an issue that we highlighted in this year's report, and the combination of slowing growth, rising interest rates, of course, and a strengthening dollar is putting huge pressures on many developing countries. It was an issue at the IMF meetings last week. Slightly cynical, I think, was our take on that. So far, as we know, it's largely very small economies that have actually moved into default, and I think the Washington-based institutions feel if that remains the case, that they can handle the debt crisis regardless of the damage, economic and social damage, that will actually be experienced by these small economies, then they can handle that. And there's a certain cynicism, I think, to that approach, which limits their policy response to the debt crisis in developing countries in pretty profound ways. And UNCTAD has long offered a much more systemic approach to dealing with developing country debt problems. And I think if the world economy does turn down even more than we expect, I think the dangers of a very serious widespread debt crisis are real. But it's not just a developing country problem. The European I think it's called the European Security and Risk Board. Is it? It's part of the of the European Central Systemic Risk Board. Yeah, in their September minutes of their discussion, they have warned, for the first time, they warned of a general they gave a general warning of the increasing risk in the European context. So the worries about mounting debt, I think, are not exclusive to developing countries. And as we point out in the report, there is an ongoing concern about corporate debt, which piled up before the pandemic, has increased during the pandemic. And the worry about the extent of zombie firms that essentially keep going by borrowing rather than producing is a very real one. And I think there are concerns that, again, a serious turn down will expose many of those firms, and with potential ripple effects across the wider financial system. So those financial risks are highlighted in the report. And of course, there are demand side risks. I think there's a growing recognition that austerity is returning, particularly in advanced economies. There's concerns about government balance sheets increases, and that's coming on top of economies that are already slowing down. There's real serious concerns, I think, if a number of advanced economies go back to the kind of rebalancing that we saw after the global financial crisis. So there are real downside risks, I think, that we focus on in terms of our assessment of the short-term prospects for the global economy and its constituent parts. Of course, in terms of the messaging of the report, we got a lot of tension as a kind of David and Goliath battle between the UN and the Federal Reserve, in which we came out very strongly against what we think is an excessively rapid increase in federal in Fed interest rates. And I think Jerry will go into this in more detail. We do not see the inflation problem across the advanced economies as a problem of too much money chasing too few goods. It's predominantly a series of interconnected supply side shocks that underpin the cost of living crisis that we see, and tackling supply side problems with demand, a very blunt demand side instrument, which is what raising interest rates is, I think, has all kinds of potential spillover effects that we are very concerned with. I think there's a sub theme in that discussion that we touch on in the report, and I think some people picked it up, which is an emerging debate about the independence of central banks. I mean, the independence of central banks has been a kind of touchstone of the neoliberal agenda for the last 30 or 40 years. And I think people are beginning to ask whether that's gone too far. And I think we have things to say about that. I think it's an important discussion that deserves more attention than certainly has been given it in the mainstream press and academia. I guess there's there's a theme that runs through the report about how we try and make sense of the COVID shock. There's a progressive narrative about the COVID shock spelling the death of neoliberalism and the emergence of building back better. And there were certainly important developments over the last 24 months that it would be wonderful if we could salvage, but we're worried that if anything, we are not out of the neoliberal woods yet. The idea of a Keynesian pivot that came along with some of the fiscal packages in response to the COVID shock, we think, have been overemphasized, and there's not really signs of a return to kind of Keynesian demand management in those responses. The idea of a bargaining pivot and a new social contract emerging, which received a lot of attention in the immediate aftermath of the COVID shock, I think underestimates the growing strength of corporate power, which predates COVID, but in many respects was amplified during the COVID shock. And unless we address these issues, I think it would be premature to talk about building back better as a new stage of 21st century market economies. So in many respects, we see the last 24 months, I think, as a bit of an interregnum, and that worryingly, we are beginning to pick up the trends that were already apparent in 2019 before the COVID crisis shook. And in that context, the report is very strong in stressing the need to look at the failures, policy failures, reform failures, to move on to a different kind of growth path after the global financial crisis, where there was a lot of expectation that that would in fact happen, and we don't think that's really the case. It was a period where monetary policy was clearly holding the policy reins. There was a failure to regulate finance in the end, despite the origins of the crisis in the financial sector. And there was a general, I think, failure to broaden the policy agenda and to put in mechanisms to coordinate policies across a whole range of policy areas. And in that sense, at a multilateral level, we're quite skeptical of the role that the G20 has played as a new platform to discuss a kind of alternative agenda at the multilateral level. And as a consequence of that, you know, the world before COVID was one, as I don't need to explain, I think, to this audience, was one of high inequality and low investment. Essentially, those were the overriding features of the post-global financial crisis era. Debt was the glue that held that many economies together. By the end of the decade, it was more a solvent than it was a glue, and it was clear that many developing countries, in particular, were either in a state of high debt distress or moving rapidly towards it. So I think looking at the weeds the policy weeds post 2009 would be a much more useful exercise than what seems to have happened in the current discussion, which is to believe that somehow if we go back to the 1970s and central bankers discover their inner Paul Volcker, then we will somehow find solutions to the current inconsistencies and imbalances in the global economy. And I think in that context, one of the things that we want to emphasize and has been neglected, I think, in a lot of discussions, is why the post-global financial crisis period was a low investment period, because in many respects, all the conditions were there for an investment takeoff. Real interest rates were low, corporate taxation was declining, regulation was weak to non-existent in many sectors, market concentration. I mean, all the conditions for an investment takeoff should have been there, and it clearly has not happened. And that's, I think, that hasn't received the attention that, and it's true in developing countries, most developing countries, probably with the exception of China, as well as advanced economies. So I think I don't think we offer any real answers to that, but I think that's a theme that is present in the report. And lastly, a big theme I've kind of hinted at already, I think, is our ongoing frustration with the multilateral system. I don't think the multilateral system responded very well to the COVID shock. The efforts of the G20 were pretty pitiful, other than the allocation of special drawing, the $650 billion allocation of special drawing rights. And we all know that there are serious limitations to the way in which the SDRs have been allocated. There's been no movement on the debt issue. The restriction on policy space linked to the WTO rules has not been addressed, and the vaccine and intellectual property being somehow indicative of the biases in that system, and the failure to make headway on that in the MC12, I think, is an indication of the limits in which reform of that system has gone so far. So that frustration, I hope, with the multilateral arena comes out from the report, because I certainly intended it to be there. So I hope it's there. I think that's the broad setting. I think Jerry will pick up on some of the details.
Thanks very much, Richard. You've put a lot of things on the table that could be chewed upon by all of us. But so I understand that you want to go next to Jeronim. Yeah, okay. Over to you.
Okay. Okay. Right. So I think I'm going to go over. First our assessment of the health of the global economy, and then discuss a little bit what we see as the causes for its ill health, and what we see as some of the important responses that should be given, and of course the responses that should not be given. Now, clearly, a main concern these days is the instability of commodity prices. We see this as reflecting on, gas prices, fuels of all kinds, fertilizers. These are themes that we're all aware of. What is important to note, and we know, in Europe especially, there's a lot of discussion about how to respond to the unstable fuel prices for heating, especially gas. Oil has been a serious problem, or was a very serious problem until recently. Then it went away. Now maybe it's coming back, depending on what the impact is of the recent OPEC decision. But there is for sure instability on that front. One of the things that is pretty clear is that the dynamic of commodity prices is very much related to global growth. So we don't know enough about the dynamics of commodity prices, but we know some things, and we know that oil prices grow when the global economy grows. So that it wasn't very surprising that in 2021 we saw a big increase, and we know that the oil price goes down when the global economy stagnates or is in a recession. What we don't know exactly is what drives what, but we know the two things are related, and this is what we see these days as well. But we also our analysis this year. This is maybe less of a. This is slightly more controversial, but I think our results show that pretty clearly. This instability in commodity prices that does very much depend on the market structure, on the structures of the markets where these commodities are negotiated and traded. So, for example, there was a lot of talk about the impact of the war in the Ukraine on oil prices and gas prices, but there was already a lot of talk at the end of February, early March, 1 week into the war. Whereas if we just look at the data, we know that these increases had started already around June or July last year. That's true for a lot of food and a lot of international food prices as well. So the question then becomes, especially for markets like oil, the supply and demand don't change from one day to the next. How is it that prices can change so quickly? And the answer is tied to the very complex rules of the markets where oil and gas are traded. And what's important to realize, in our view, is that the prices in these markets are very much driven by the financial operators, not by the operators that trade these commodities for final use. So it's not the airlines that demand the fuel, but it's the traders that build all the positions in derivatives that eventually the airlines buy their fuels from, or maybe they don't. And so the question a clear answer to commodity market instability is to take a look at the market structure and how concentrated it is, and the oversized power of the financial operator. And this has unfortunately been fairly absent from the debate, but it's been one of the drivers of the instability of this year. Now, this has sparked a whole conversation about the energy, about a whole energy crisis, an actual crisis of supply, of availability, if anything, and concerns overall, that has made us look into how the global economy is doing in terms of its use of energy. And so we've looked back a little bit, trying to update some of our work that we did under the banner of the Global Green New Deal. And for sure, we can say that in terms of energy efficiency, the global economy has improved, but we know it hasn't improved on all accounts, not for all energy sources, and it hasn't improved everywhere in the same way. The developing world has made tremendous advances in energy efficiency, but it's got it has a long way to go. The energy intensity of its growth, not of its GDP, but its growth, has had a staggering improvement compared to the energy efficiency of the energy intensity of the growth of the developed world. So that means that the growth of the developing world is more energy efficient than the growth of the developed world. And this is something they don't get enough credit for, especially in the discussion where we say that it's China that's polluting or India. And that's true, but it's also true that they have tremendous challenges, developmental challenges to face. Now, one or the other, and I'm gonna, you find a lot more detail in the report, but I'm gonna try and go for the main pillars of our issue this year. Another one of the challenges that we faced, connected to the inflation and the commodity instability, is what's happened to labor incomes. Of course, they've been under tremendous pressure because inflation's been high, but even there, nothing new. This year, inflation has taken a tremendous toll on the real value of wages. But as we can see from that chart, this is a process that has had tremendous help this year, but it started decades ago. And following a dynamic that is also nothing new. Every time we've observed, well, in the last several three major crises, we've observed this dynamic. When the crisis hits and there's a recession, the first thing that falls is profits, but then they recover very quickly and they gain more ground. And this is something that this year has been confirmed by the data that's been coming out about the sector level data that's been coming out about the last 2 years, that shows that in fact markups or profit margins, however you want to measure them, have been responsible for a much higher share of the price increases than they have been in the preceding 4 decades. We know this about the major developed economies because we have data for that. For the large developing economies, it'll take a little while longer, but before we have the data. For most economies in the world, we might not have the data anytime soon. But this is, again, a tremendously important factor in understanding the crisis that we're facing, because it's one thing to say that costs are increasing in a blanket way, and it's another thing to be able to say what costs are increasing. Now, the current policy response, dominated by monetary tightening, is effectively scapegoating labor as the main responsible for the price increases, whereas in fact labor's got nothing to do with it, and if anything is on the receiving end of a regressive redistribution. And again, there's some data about the US, because that is the more meaningful information package that we started from. So you see there's a nosedive of real labor remuneration, and at the same time a great takeoff of markups that have been associated with this price increase across the board. Now, of course, this does not apply to all categories. It applies to some, but commodities are a sector that have been a very powerful conduit of markup increases. In terms of policy responses, as we all know, the main item on the table has been this ratcheting up of interest rates on the part of central banks. Now, this is the visible top of an iceberg that is inflation targeting, their approach to managing fluctuations. That says, well, if the economy is too close or above its potential productive level, then we have to rein it in. Problem is, like everything in the details, this potential productive level is no, fixed level, given that falls from the sky, but it depends on the path that the economy is following, and it can be very much influenced. So when we consider that as a given, then of course we inevitably misjudge the timing and the closeness to it that the economy is exhibiting. Despite this is a tremendously popular approach. In fact, it's the dominating approach in central banking. And so we are now all experiencing the consequences of this. In other words, we have price increases that are effectively mostly generated by energy prices, which are caused by specific market structures that are very concentrated and very financialized. But the response is hitting back at the whole economy, and particularly at employment and labor incomes. And this applies to the whole world. In some way, developing countries are more used to higher inflation rates, because some of them, in the most fortunate cases, because they are in the middle of structural changes at all times, and that generates tensions between sectors that produce inflations. But the global north is not used to it, because it's been underperforming the central bank's inflation targets for a couple of decades. So now this comes as a shock. Now, prospects. Well, of course, like everybody at this point, we do see a darkening of the prospects of the global economy for the rest of the year and for next year, and I would say probably for the near future as well. But the important thing, in our view, is to realize that this isn't an accident. This is no freak event. It is not being caused by rogue events that are happening in the global economy, like a war, like the pandemic. This has been mostly triggered by a specific type of policy response. And a fact that is critical in this respect, in our view, is that in the conversation about that Richard was mentioning about the response of the neoliberal approach to economic policy since the pandemic, and how maybe we've seen the death of neoliberalism. Maybe we're in the post-neoliberal world. In fact, we are not. And the main marker of that is that since the end of 2020, we've witnessed in all the global policy circles already a very strong pressure to return to the pre-COVID policy trends, which were effectively made of two fundamental elements. One was some form of endemic austerity, and the other was the idea that the world economy can grow out of trade expansion. So what we've seen is this very, very clear effort to what is called now rebuild the fiscal buffers. It's another way of saying that the government should stop supporting the economy with fiscal spending. And at the same time, the strong desire, almost the obsession of protecting trade as the main victim of the pandemic. Now, this has not, clearly has not, this policy reversion to its trend has not helped. The prospects of the global economy are darker than they were before 2020, when they were already dark compared to what they were before 2009. And so the question now is what to do. And here we have 5 broad areas that we believe require very serious change of course. One is in the inflation management policy. We cannot really be successful in the management in the fight against inflation if we don't really address its causes, and that's not what's happening. What needs to happen is that we need to tackle the problems with the market structure and the financialization of the key markets. There's an important inversion that needs to take place in the way we manage growth, because right now the G20 and other thought leaders in policy making see the function of macro policy as exclusively a counter-cyclical function, forgetting or overlooking completely the fact that growth needs to be managed over the medium and long term, and so demand needs to be managed in a way that encourages the creation of new capacity, not just to pick up the slack whenever there is a low crisis, and then let private investment do the rest. Private investment is a major issue here. With the most recent data confirm this depressing trend that we've been detecting for a long time. Productive investment, the creation of productive capacity or fixed capital formation has really stalled for a very long time. We're talking something like 2 or 3 decades. But this is in the face of a very concerted effort to bring about the supply side structural reform that's supposed to encourage that investment. What happened is that those reforms encouraged financial investment. Financial investment effectively crowded out productive investment. And so now we find ourselves with an underinvested economy just when we need to face the challenges of the energy transition, the rebalancing of the tremendous inequalities we face, an infrastructure crisis, et cetera, et cetera. Now this, of course, brings up the other issue of where does distribution stand? It doesn't stand in a very nice place, because as we mentioned earlier, distribution has in fact been deteriorating. We talk about economic inequalities all the time. There's all types of them, but the signature one is what's happening to the labor share, and we see that what's happening to the labor share has not been a pretty spectacle to observe. Now, there's several things we can do for sure. There's interventions we need to do on wage growth because they've been falling in real terms. There's interventions we need to do in terms of tax progressive or non-progressive structure of taxes. Now, that's a very tricky thing to do because the practical challenges are enormous, but that's an important impact. And experiments with things like windfall taxes for extra profits this year have been made. There's procedural obstacles everywhere, but that's clearly something that is important. And finally, if all this needs to have a chance at generating the investment we need and the redistribution we need and the conversion of our energy systems in the way we need them, this cannot happen without the appropriate multilateral support. And in this sense, in the coming installments of this year's report, we'll see we're presenting our views on how that can happen through things like transfer unions and payment unions and cooperation between the southern countries and the South and the North. I think I'll stop here.
Okay, thanks very much for taking us through the main elements of the report. Over to you, Anastasia, before we head into a discussion with colleagues.
Thank you very much. Thank you very much for Alessandro for handling my slides. So this is the cover banner for the mini web resource where you can play with various charts coming from the opening chapters of TDR. It's very well made and illustrated to emphasize the policy moment of today, that we have to deal with clearly a spectrum of very urgent risks, but it can only be done towards a more resilient way once we understand the long-term nature of the causes of the current crises. And possibly we're warning about the recession, but it may just happen that we will go into either a series of crises or certainly a more fragile world next year. Alessandro, next slide, please. Thank you. And just to reiterate what my two colleagues already covered, the legacy of the previous big crisis that we all have lived through from the global financial crisis is very financial. It was supposed to be, it was assumed to be financial in nature, but it left us also with a very disjointed world. Paradoxically, or not paradoxically, if you understand the political economy of it, we came out in 2009 with larger, bailed out, more prominent, and in many ways more powerful banks. After years of quantitative easing, we ended up with financial asset bubbles, wealth inequality, and classes of people who own the majority of the assets around the world, as opposed to the 90% of those who don't. We're living through, or we inhabit a world economy with a growing and more complex shadow banking system that had been completely unaddressed by the reform in 2009 and 10. And as a result, we have a very unfinished financial reform, not to diminish the value of the detail that was discussed, let's say in 2009 and 2010 by some financial regulators, mostly in the US, but some joined from other countries. But really, a lot of those details and proposals were really not implemented, ignored, or overturned by the following administrations. On the other hand, in the so-called real economy, we have a continuing underinvestment, just as Jerry illustrated to you, in the real economy and the public sphere due to years of austerity. We have the years of fiscal austerity as a set of measures that was chosen to deal with a problem of private debts, which is, of course, misaddressed and painful and costly. And probably most importantly for the context of today, we ended up with central banks as market makers, as lenders of last resort, as risk takers of last resort, as bailouters of last resort. We pretty much ended up with central bankers as a very powerful political institution that kind of is in charge of handling economic recovery and stability. As a result, or partly as a result of it, the economic cost of COVID that came in 2020, for most of regions of the world was actually higher than the cost of the global financial crisis. You can see it on the left-hand side of the chart. This is from TDR 2021. We simply compared the impact of the two crises on major economies and economic regions. Although by share of GDP, by how much the economies have suffered or contracted, it actually differs from region to region, and it depends where you are in the advanced vis-a-vis the developing world. But the key message is that, of course, in 2020, just as COVID was supposed to come to an end, and as a set of policy measures that were applied during that time were supposed to be bringing the world back to pre-COVID time, which in itself was a fallacy, because to go into an already weakened state from the global financial crisis to have it as a kind of new equilibrium to start your recovery is a false solution. But even in 2020 and 2021, we were already in a fragile and weakened state. And we already warned last year in TDR 2021 that it's quite likely that the superb recovery, not having been seen in the past 50 years that the world observed at the end of last year, is not going to last very long. The 5% growth for the world economy as a whole is a very short-term success, and quite likely it will be decelerated very quickly. We were, in fact, too pessimistic at the time. Too optimistic at the time. We have now revised our forecast downwards. But I just want you to refer to my personal hero, Hyman Minsky, who didn't live to see the various crises that he predicted. But it's interesting that he was writing his historical exploration what the Great Depression can happen again in the US, just in the time of the 1970s and the early 1980s, when Paul Walker and others were regulating the financial side of the economy. Minsky concluded, observing the key economic changes driven by finance in American capitalism, that in fact, Great Depression can very well happen again, even in this sophisticated, institutionally advanced capitalism. But in order to avoid that, you need to have workable coordination of two big pillars of the state of political economy, the big bank and the big government. And on the slide, you can see, of course, what it applies. In 2009, the only solution that was found to be useful is only part of that formula. It's a big bank. So that's why central bankers ended up as key crisis managers or governors. And they remain in this position today. A big government came only as a sense of radical emergency measure during COVID crisis. And I would say this was the real Minsky moment for the world economy. It wasn't the collapse of the banks in 2007. It certainly wasn't the recession in 2008. Minsky never wrote himself about any moment, but the key moment when the state has to intervene through both pillars is in fact the set of policy interventions we observed during COVID. And so it lasted. It was a very brief Minsky moment. It surprised many. It delivered some results, albeit unevenly, highly unevenly, globally, internationally. And this inequity across sectors, across social groups, across economic developing regions still lasts with us today. So as Jerry already said, and he showed you this graph on his presentation, due to that, we entered into February 2022 in a structurally weaker condition, much structurally weaker than we were in 2020, and even weaker than we were in 2009. The red line is where we were supposed to be without various crises, and the blue line is where we are now. Maybe somebody can say it's not really a major disparity between projections of growth, but globally, when you consider the aggregate combination of participants in the global economy, I think our estimation is 3% difference. That's quite a lot. It's a massive chunk of world product and wealth and value. In fact, due to that, our expected same loss, the output gap for 2023, is also quite stark. It varies through countries. We don't deny that some countries will benefit from the current political economic context, but for most of them, including the advanced economies, the projection is sharply downwards. You can download all those charts from PDF files on the web. So of course, all these downwards projections under the cloud of very high inflation, double-digit inflation in many countries, raises the specter of either stagflation or a bigger crisis that Hyman Minsky and others were dealing with academically and in the policy world. There are at least 4 areas where there are some ostensible similarities between the decades. There is, in terms of business cycle or political cycle, of course, the contraction now comes after a period of quite abundant finance-driven growth when central bankers maintained interest rates at a very low level. There is very high inflation, as on our maps, you will see 69 countries already experiencing double-digit inflation, and 31 of those countries are in the developing world. Growth is slowing with a combination of rising prices and the unsustainable debt levels, especially in the developing world, but as Richard said, in both parts, in the advanced and developing countries. raise the risk and the prospect of another lost decade. But we are saying in the report, and it's very important, that due to a number of reasons, today's context really cannot be compared to the 1970s, or it shouldn't be compared to draw political lessons. Core inflation today is driven by various factors than it was in the 1970s, and these are very different factors. I will show you in a second why. The recent commodity price increase, when measured in real terms, hasn't been as high or as dramatic as it was in the 1970s. As Jerry already explained to you, the energy intensity of GDP actually declined considerably since the 1970s. There is a key difference in the role of wages and nominal wage growth and its relationship to overall price level. The types of debt are different to the 1970s. That was a very consolidated lending to key governments in the developing world. Today, debt is complex. It's both public and private, and it stretches globally. And in the financial system itself, the regulatory power of central banks is undermined by this phenomenon of large and growing financially innovative shadow banking, which makes their effort even more unclear. The overall result of the policy intervention more unclear. And so due to combination of all these factors, we really cannot rely on central banks alone, although we are now almost used to that. They were quite key institutional providers of stability during the past two crises, but it shouldn't be taken as a lesson for today. Partly because the key tools at their disposal, interest rates, market intervention in terms of liquidity provision or collateral widening, or in fact, crisis coordination, including internationally, these are, if you look at them, they're very blunt instruments. They're in a very financialized, credit-driven, credit-dependent world, they will have a massive impact, and you have very little flexibility for nuance. One reason why the bluntness of interest rate as an instrument is actually quite inappropriate today is the structure of inflation. On the graph, you see inflation, the components of inflation, the driving forces of inflation from 2018 to 2022, where you visibly see the three main parts. The blue line is the demand-driven factors that can respond to monetary contraction, whereas the other two parts, and together they constitute the largest part of price increases, have nothing to do with demand-driven or, as Richard said, money chasing too few goods. They're very different. So the supply side disruptions, they are, of course, a legacy of the pandemic, and they are multiplied by the tensions and impact and crisis from the war in Ukraine today. But it's very clear that monetary tightening, which will make credit more expensive, more difficult to obtain, more difficult to distribute, will only aggravate these supply side problems, and they will not solve them. In fact, therefore, that part of the crisis will linger into the near future. The group of factors that is labeled ambiguous on the graph includes many, but we attribute to them the financialization of various markets, but chiefly commodity markets and energy markets, market concentration, and corporate behavior. So this particular chart is supposed to give you some numbers to the phenomenon, to the structure that Jerry already highlighted. So everything is now very financialized, everything is tradable, but commodities and energy are particularly tradable because in 2002, the big banks, starting with Goldman Sachs, invented market indexes through which these commodities are now being traded on primarily US financial markets, but of course globally. Before 2002, the balance between the so-called good people and the speculators, the commercial hedgers who use these commodities and energy and oil, for example, for their daily economic needs, for their inventories, was about 70 to 30 or 80 to 20%. So there were 80% of commercial hedgers and 20% of speculators who provided liquidity. They were there trading, pricing, they were doing the quotations, but the activity was still useful to the overall market because due to them, the good guys, the commercial hedgers who actually were participants in the economy could get their insurances cheaper. But today that ratio went over 70 to 80%. So the balance of market concentration and market play has been reversed. Unfortunately, the regulations that were discussed and only very marginally implemented in 2020 to curb that speculation following the previous oil peak in 2008 were not complete, and some of them were reversed, and some very significant loopholes were left in the legislation. These loopholes are now being exploited by mostly banks who are trading, who are using them for financial dealings. At the same time, inside the market, and this is the data for US, Jerry said it's still to be complete for other economies, but it's already very indicative. Between 2020 and 2022, more than half of average price increase in the US non-financial sector is now attributed to corporate profit margins. This is historically compared to only 11% before in the previous 40 years. And there could be many theories why these corporate profits have increased. What do they mean? But really, even the visible contrast is very telling. The implication is very simple, right? Raising interest rates alone actually doesn't do anything to curb these two big forces. It will in fact make them worse, and therefore will make the crisis linger into the future. And therefore, in this TDR, we call for very specific set of measures to address these more structural conditions of the current crisis, for stronger and more comprehensive tool set of market travel regulations that already exist. We know what they can be, it's just that they need to be implemented. We call for price controls to protect the vulnerable communities, both in the advanced and developing world. As Jerry said, windfall taxes, because the revenues from commodity trading have been quite high. We call for closure of those loopholes that still facilitate corporate arbitrage globally and continue to enable financial speculation via third country subsidiaries of major financial institutions. We're calling for international efforts to make liquidity available to countries in need. Of course, there has to be help with debt relief and debt restructuring. And overall, the aim of any policy discussion and policy intervention should be to avoid a policy-induced global recession or worse. Because this is where it's heading now. It's not a natural phenomenon. It's not a cyclical phenomenon to go into a deep dip globally. And the current chosen set of policies used as a main tool against the coming crisis is only going to make things worse in the next year. So we're calling for strategic policy mix that will incorporate financial, real economy, trade, investment, and multilateral sphere. Thank you. There is another slide with the yes, and on the website you can see very nice videos, podcasts, and illustrations for TDR.
Okay, thanks very much for that comprehensive presentation of a report that is wide-ranging, both analytically as well as directionally in terms of policy advice and guidance that you might offer. I think it raises a whole range of questions. I have some myself, but I think what I would prefer to do is to invite colleagues. Let's take a round of questions. Please frame a question and as opposed to a long statement. And after a few, then we'll go. I understand, Richard, you may need to leave before the scheduled end of this session. So let's get a round in at least for then. And so the floor is open, both for people in the room and online. Yeah.
I have a question, perhaps. Well, I will just, thanks for the presentation, first of all. very clear. I would just want to ask, what's your take on whether the demand-driven inflation pressure could be attributed to the drawdown of savings, excess savings that were accumulated during the COVID crisis, and to what extent, if you want, perhaps monetary policy now faces the struggle of having to compensate or offset some of the perhaps potential mistakes that fiscal policy could have made during the COVID by just implementing these horizontal unconditional policies that saves all. You're probably familiar with the graphs with the exit rates of firms. Data is collected by the OECD, for instance, showing that 2020 was the highest a year in terms of the exit of firms. It was it hit a record in terms of the basically having a super small exit rate of firms, meaning that basically everybody was saved. All firms managed to survive, and that was not natural even for normal times. So maybe I don't know what your take on this is. Yeah.
Okay, thank you for that. Sang-Yeon.
Thank you. First of all, my big congratulations on the report. I have seen your report in the media so much recently, and including in the annual meeting in Washington. And sorry, actually, I was a bit late as I missed the Richard presentation, but I have seen already a couple of the interview with him, so I reasonably guess actually what he has said in the presentation. I have a three quick question. One, about the policies. I completely agree. This is to a large extent like a policy-driven recession. That is what we are facing right now. What is your assessment about the possibility of the policy shift in the coming month in the current political situation? Or, I mean, of course, this is quite a guessing game, but I just want to have your perspective on that. The second is, even if we manage to change the policies along with the all set of the policies you suggested, are we going to continue to suffer or the damage we have seen already? So what I'm trying to say is that do you already start to see a bit of the structural long-term damages from the existing policies so far on the economy and the labor market, or we are kind of in a kind of good chance, if you like, if we reverse some policies, we can have some kind of undo some of the damages made so far. That's the. If you allow me, my third question is about China. How does all this China story fits into all your the policy narrative and analysis of the report? As you know very well, the Chinese Communist Party met actually this week, this week basically. They are now basically claiming that there is a new way for the modernization, which is available to the world right now. So they move beyond just a simple democracy. They're now talking about modernization. Probably they are going to even talk about structural transformation at one stage. I don't know, at the presenter I heard from just Jerry and also Anastasia, the Chinese story doesn't seem to feature very strongly in this story. So I just want to hear a little bit more about that. Thank you.
Okay, one more question, Janine, and then we'll go to the panel.
Thanks for the presentation. It was really great. I was just wondering if you could speak a little bit more. I guess I thought you would speak a little bit more about the rising interest rates in the US and consequences for the debt in developing countries. So at what point, I mean, have you modeled, for example, at what point there's a tipping point and we get into a real problem of a debt crisis? And then my other question is actually just a little bit more practical. I thought the analysis on the commodity markets is really interesting. Could you speak a little bit more about what are the reforms needed to stabilize prices in commodity markets? One thing is energy, but related to energy, I'm thinking about fertilizers, particularly for agriculture and the consequences for the developing world. Thanks.
Okay, many thanks, colleagues, for those questions. Richard, let's invite you to respond and kind of manage the responses, if you will, from colleagues.
Yeah. maybe, yeah, I'll leave some of these obviously for colleagues. I mean, the debt crisis story, I guess, Jenny, I mean, it's not a new story, right? We're not telling a new story. We're trying to follow through on the consequences of the Fed's decision because, you know, the Fed always says, and to some extent they're right, they only have a domestic agenda. That is, they don't have an international responsibility, even though at our gatherings, they will tell you we take into consideration the potential spillovers of any decisions we make on other countries, and which is clearly not true, first of all. And second of all, they do have international response. I mean, they have swap lines, for example, that they opened up during COVID for a select group of central banks that, you know, is driven as much, one has to believe, by geopolitical rather than economic decisions as well. It's not a multilateral response. So it's a fun, you know, in a dollarized world, it's clear the Fed has a footprint that goes well beyond the United States. I mean, that's clear, and they don't, despite the rhetoric, we don't think that they take the resulting responsibilities seriously enough. So that immediately obviously puts us on a collision course with the Fed in terms of what we say. In terms of the actual analysis, I mean, we were struck by some of the Fed's own research in which they found that for every 100 basis points increase in the Federal Reserve interest rate, growth in developing countries over the subsequent 3 years, it falls by, I think, 0.8%. So if you take that as a figure, now we're 300 basis points above what we were at the beginning of the year. So that's a fairly large hit to developing countries immediately from the Fed's own calculation. And on top of that, of course, and we know of, you know, in a period of uncertainty, US financial markets are a harbor for safety of investors. We've seen the incredibly large rise in the value of the dollar against many countries in the world, but particularly in emerging economies, and that's had, for countries that have borrowed extensively in dollars, of course, most developing countries on international capital markets have to borrow in dollars or to some extent in euros and pounds. You know, that the squeeze it, but none of this is new, right? I mean, it's all a very familiar story to us, and I guess what we haven't done, which some others, I mean, we don't kind of, you know, chart out the countries that are going to go under over the course of the next. Some people have tried to do that. That is a very difficult exercise to do because debt crises have a very idiosyncratic component. It reflects many local circumstances. You know, it depends on the sequence of the servicing of the debt, which varies tremendously across countries, and the kind of instruments that they have borrowed through. But, you know, I mean, the story is of intensifying pressure, and a multilateral system that doesn't have the means to deal with that, or hopes to muddle through, you know, through what we've seen. Some countries entering the common framework, even though that clearly has failed, because no country's actually, despite the fact that it's been there now for 2 or 3 years, no country's actually worked itself through the common framework. The debt service suspension initiative that was launched through the G20 was pitiful in terms of the amount of relief it gave. It wasn't even relief, it was suspension, which means countries actually have to pay back in the future. So none of the mechanisms that have emerged are consistent with the potential, the damage that we're already seeing, and worse than that, the real threat of significant debt crises. So that's, I guess, that's the story that we tell in the report. It's kind of familiar, right? It's not, you know, we'd love to say we've discovered something, but we don't. You know, we're just seeing a playbook that we've kind of read before. What was important was to just emphasize the need for central banks in advanced economies to recognize their decisions have profound impacts beyond their immediate constituencies. domestic constituencies. Although we also argue they have profound consequences on the domestic constituencies too, right? I mean, for the reasons Jerry talked about. In terms of, I mean, just quickly in response to Sangon's, I mean, the opportunities of policy shift. I mean, of course, the funny thing at the bank, at the meetings was we kind of were experiencing in real time a policy shift, which was done by the UK government. And now I don't want to defend their particular mix of policies, which was clearly a disaster. I think what was shocking, though, about that, and what it highlighted was this ongoing power of financial markets to dictate policies to more or less democratically elected governments in the case of the UK. And that's, you know, and that was an indication of just how little has shifted in terms of the kind of the power structure in Western capitalist economies and the, you know, and the limit and the profound limits that could have, not necessarily for the kind of misconstrued policies of the UK government, but for any government that wants to make a significant turn in its policy direction. There's a real profound, you know, a lot of people were kind of gloating at the fact that markets had destroyed the kind of last bastion of kind of fundamentalist market ideology, which you know, you can gloat for a while. I think there's a much more profound question underneath that gloating about the ongoing power of financial markets in dictating to, you know, that was what was Clinton, you know, Clinton's advisor who said he'd love to come back. The thing as a bond market trader is I mean, that still seems to be, you know, that seems to be, you know, a choice of you know, for power brokers, and that was, I don't think we've had enough. I don't think we've paid enough attention to that. Certainly, the kind of mainstream has kind of celebrated the fact that financial markets have that kind of power over democratically elected governments. I find that, you know, difficult to swallow. The China story. I mean, I guess it's fair to say we struggled with the China story in this TDR. But you know, there was some who were more hawkish than others about where China was going because of its own particular immediate set of problems, which have to do with its choice of responding to COVID, and also its the housing bubble that has blown up over the last 5 or 6 years in China itself, in a funny way, a response to what happened in 2009. So, but there is, as you're right, I mean, China, but there also, I mean, and the back of that, of course, is the geopolitical question of you know, the concerns of Western governments that China is both not playing by the international rules of the game, whatever those are. That's one of those things. They're not playing by the international rules of the game, which is a slightly odd criticism, for example, of the Biden administration, which is now clearly not playing by the international rules of the game to build up its own sectors in, for example, chip making, that is part of the package that the US government has enacted. And China clearly has China clearly has a strategic vision about not getting caught in the middle income trap that it sees many developing countries as not being able to overcome in their own, you know, so they look at other developing countries that have somehow not been able to overcome what seems to be the structural pressures that face many middle income countries as they get to between $10,000 and $15,000 per capita. And it has a very clear strategic vision about what it needs to do to build up high-tech, high-productivity sectors that will get it beyond those hurdles. And clearly, many Western economies are worried because that sounds like it will become an even more intense competitor in some of the sectors that now are dominated by Western firms. I mean, that's clear the case. You know, I think there's a lot of questions that arise from that we don't even try to address in this report. But I think you know, again, to go back to a point that we both made, Anastasia too, you know, we need, if we're going to avoid the destructive nature of that kind of rivalry, we need a different type of multilateral system that can at least harbor the hope of win-win solutions rather than enter a much more conflictual type of world. And that the weakness of multilateralism right now is, for all kinds of reasons, I think is intensified by that threat of a conflict between the two largest economies in the world. I think the other questions are more specific to you and Anastasia.
Okay, I'll pick and Jerry will have to deal with the.
Let's go, please
Another?
briefly respond to them, and then we'll get another round of questions.
Okay, very briefly. The question from Jenny on the developing country data, I think Richard covered it extensively, but of course, there is an interesting section in, I think it's chapter, in fact, it's chapter, yes, it's part 2 and chapter 2. So there is part 2 of the report that is yet to be launched later in this year. We're hoping that deals with the regional integration issues, with the role of China, with, you know, some specific rivalries or tensions in the area of trade, public financing, or investment, in fact. But that will have to be set as a separate discussion to the very current context of crisis. So there we raise the question of to what extent attempts by some developing countries to shift away from the dominant position of the dollar we're not questioning their viability, but their effectiveness. And we conclude, due to the power, to the weight of the financial system, to the role of financial securities in delivering the necessary debt investables, including for developing countries, that the dollar dominance is unlikely to wane despite current tensions, risks, and initiatives to even switch trade flows. Trade flows assume a very minute proportion of overall kind of transactions in the universe of, if you want, capitalist economy. To the question of structural, already visible structural responses, I will give you my personal story of about 2 weeks ago. I was on the plane to London from Geneva, and we had to stay 2 hours on tarmac in Geneva, waiting for Gatwick to accept the plane because Gatwick Tower didn't have staff. Before COVID, Gatwick air traffic controllers, I think the average wage was around £250,000. That's a lot. That's a well-paid job, but a lot of people were fired during COVID. They were not replaced. They don't seem to have any incentives to change the status quo. And this is now observed across a variety of industries, and you can see the political consequences of that every news bulletin coming from London. At the same time, you can also see, and this reiterates what Richard was saying about the power of financial orthodoxy, that the decisions now being taken in the political center in an advanced country in the UK are mostly to do with the markets. The markets don't like it. The markets are valuing it. The markets are seeing it as risky. The markets don't trust you. And this is not to say that, you know, markets are irrational. Probably they have a lot of rational expectations, but the political discourse and therefore decisions and policies are, even in the very structurally weak state, even when already a recession is underway, they already have a double-digit inflation. There is clearly issues of, you know, economic security for the country. It's still not being really challenged, reversed, or changed. Question of China, we deal with it a little bit in the discussion of the risks posed by shadow banking system, which has grown in China, and despite the regulatory effort by the authorities, it still remains a problem. I think our overall expectation is that the slowdown in Chinese growth is unlikely to be temporary. We take it as a 4% still for next year, but overall, kind of it's the first time in the Chinese growth story that all these risks are now conflating into a global economic impact. And I think it will be an issue for us to discuss in next year, but it needs a thorough understanding rather than just a sketch. So with that, I leave it to Jerry to deal with the
Thanks.
rest.
Is there anything that has been posed that hasn't been covered already that you want to add to?
Yes, the saving.
Yeah. No pressure. Well, I think it's important to add a chapter to the story of the rising interest rates. The increase in interest rates in the United States has far-reaching consequences in the developing world. Part of it is what Richard mentioned is the debt related to debt, that type of risk of insolvency. Not because that service becomes more expensive, but a lot of that comes through exchange rates, because that service becomes more expensive because debt is more expensive, but also because the dollars are more expensive. Approximately half of foreign debt in the world, in the developing world, is denominated in dollars. So developing countries are in the situation where they work hard to pay off their debt, and one day they wake up and their debt is bigger. If it happened with our mortgages, it'd be insane. But that's an urgent, immediate problem. But there's a deeper, longer running structural problem that has to do with the other parts of the balance of payments constraints, because this reshuffling of interest rates and the fact that the dollar becomes more expensive makes it harder for developing countries to fund their imbalance, to fund their deficits. So that means that for them, all the payments that are necessary for development, especially the payments of capital inputs, become prohibitive. And that means that any opportunity for investment, the small the effort, the surviving investment effort, then becomes much harder. It's doomed basically because they have a harder time funding this imports. And that is something we don't know how long it's going to stay with them, but it for sure right now is having a very strong chilling effect on that. That is going to compound another problem that's, let's say, in the multilateral sphere. That is global climate policy, because we want developing countries to invest, to green their economies or whatever, to mitigate and adapt however they can. But for them to make these investments in the complete absence of an agreement of technology transfer means, getting a hold of more dollars, which obviously has become harder. But developed countries are squeezing them with this course on carbon border adjustments and this climate protectionism. So they're between a rock and a hard place, and one of those is the rise in US interest rates. The other one is the external circumstances they were already facing. And as the two things close in, then for them, it becomes for a lot, especially the highly indebted ones, but not just. Even a country like Brazil, who doesn't really have a foreign debt problem, is facing this problem, of course, because now they need to import a lot of stuff. And someone was asking what the opportunity. Sankan was asking opportunities of policy shift. Politically, we'll see really what happens in Brazil. It is probably the most consequential question mark that we're going to solve in a few weeks.
Is this
I think, yeah.
Okay. Very good.
Okay.
Let's pause
Yeah.
here, take one final round. We have about 7 minutes left. Let me just put a point of fact on the table here. Speaking about the potential for policy shifts. The Secretary General of the United Nations last week wrote a letter to the group of 20 finance ministers and central bank governors. I don't know whether people are aware of this, but it calls for what I would characterize a much higher degree of ambition on the part of policymakers around the world, and in particular for a sustainable development goals stimulus package, which, if you go into the various elements, is essentially a reform of the international financial architecture, which you highlight as an important priority in your work, including an enhanced debt relief, leveraging better the MDBs and public development banks to support the SDGs, involving private bondholders and sovereign debtors in debt relief reform, structurally bolstering liquidity support for vulnerable countries through an enhanced use of the SDRs, and aligning financial flows more generally with these issues. So this is in a way an agenda for what part of what you're calling for. And so I would just invite you to comment on whether these are some of the elements you had in mind when you were calling for it, or are there other elements of international financial system and international financial architectural reform that you would advocate. So that's one question. Let me go to the audience online, and if you could go to the top of the screen. I want to take the first one, Alessandro, which I can't see currently. Anyway, the question was a question about, you talk about the dearth of investment following the great financial crisis. And the question was, isn't that in large measure a result of the rising insecurity and precarity that was evident during this period, and the ensuing uncertainty that creates? And uncertainty, as we all know, chills investment, particularly longer term investment. So that was the second question. And then let me go to colleagues for one more question, if there is one here in the room. And if not, very briefly, please. Yes.
Yeah, thank you. I have a question which relates to what Rick said. This next year, we will have the SDGs will have the midterm review. And of course, now we are all asked to look into the SDGs and how far we can go and what can be achieved. So my question is, what is your assessment or your opinion? How would the current situation and the crisis we have affect the chances to move towards SDGs and to achieve, or would there be any chance to achieve any of these goals, in particular from an African perspective? Thank you.
Great. Many thanks for that question. So we put 3 on the table. We've got about maximum of 5 minutes for you to treat some elements of that, but we do want to try to end on time. So over to you. Anastasia, would you like to start?
Okay, I'll deal with the easy one. What are the elements of the international financial reform that we advocate? I think, as you listed and quoted from the letter, it's necessary, but also limited just to list the financial or even international financial measures as the developmental pathway to a more sustainable future. The problem with the financial system and its power is that it's inextricably connected to anything we do. So reforming, for example, some markets or relieving some measures or enhancing liquidity in one sphere doesn't deal, for example, with the other underlying financial corporate problem of corporate behavior and investment internationally. So I would say that a much more bold and ambitious agenda will be, in fact, a proper multilateral approach to corporate world, to monopoly power over markets. They're all over the developing countries, the damage it's done. Much more research needs to be done, and a different conversation needs to be open, because in many ways it gets financiers, but also the corporate elite and the corporate world off the hook. The more we talk about, capital account measures or flows, or these are only the exterior of the underlying problem, and they do not go to the core. The core lies with the corporate entity. The greatest problem to SDGs is, of course, the impact of the war and the likely effect on climate goals. Yeah, and overall the geopolitical risks of rupture. So to me, it's very tangible and clear and dangerous. Chills precarity long term. Yes and no. I like the argument about precarity very much. My close friend wrote an award-winning book on capitalism of precarity. However, the same investors have absolutely no chill in investing quite long term into financial securities, into bonds, corporate or government, or in fact into going to semi-private projects, partly financed by developing countries' governments, as long as they're financed or supported by the government, because that takes some risk off them or gives them insurance. So I think maybe, again, it's not a long-term, short-term distinction. And although risk is important, it's the political control of that risk that matters. So I don't know. I think, again, the long-term, short-term patient capital discussion is unfortunately too limited to deal with the structure of the problem.
I don't know that the questioner was so focused on long, short, as opposed to precarity equals uncertainty, insecurity equals uncertainty, and that more generally chills investment.
No, they're still investing in finance, so that's very uncertain. Finance is very volatile. Why are they investing in financial assets? Okay, Jeronim?
Yeah, well, on Guterres's letter, it's great in many ways. It's great, especially for what it means, hopefully, for the FFD discussion. Because the discussion on financing for development is based on the idea that there's not enough money in international development. In fact, maybe there isn't enough money, but sure there is too much finance. And that is exactly one of the problems that we deal with every day, because the financialization of development and the forgetting of the problems of development, the structural problems of development related to investment and structural change is for us the key issue. So in that sense, it points at that problem. It doesn't list the financialization, the larger financialization issue that, for example, happens in the food markets, the agricultural markets, the stuff that Janine hinted at before, and which are really getting in the way of development in many ways, and for sure are responsible a lot of the instability of the last few months. And so the investment story, for sure, it's got to do with uncertainty, but from the point of view of investing firms, the uncertainty is effectively an uncertainty of revenue. The uncertainty of revenue. So there's two types. There's the confidence fairy that we've always talked about. It's more in the financial markets. And then there's the uncertainty of revenue that prevents an industrial manufacturing firm from investing. And that is very much related to the income that the disposable income that people have, they can use to purchase those commodities. So you don't have enough, you're not distributing enough labor income. Of course, you're going to have uncertainty of revenue for the investing firm. If you are strangling the government ability to sustain demand, of course, you're going to have uncertainty of revenue for investing firms. So in other words, yes, uncertainty is critical, but it isn't something that is somewhere up in the sky. It is something that very much has to do with this income distribution. And we're done. So one word about any chance of achieving the SDGs? No. But for sure, not the net zero, not the Paris Agreement goals at the rate we're going. Not a chance. The question is then, what is the second best that allows us? We've got three challenges. We've got the development challenge, we've got the inequality challenge, and we've got the climate challenge. These three things are not being dealt with in a consistent way right now. And while we're trying to, some days we push one, some days we push the other, there is no plan. And there's no chance by 2050. So the question is, what are better second best targets that allow us to have a reasonable plan for the whole world to get there? And that's the discussion we should have.
Okay, well, thank you very much, both of you, and also your colleague Richard, for coming here to the ILO to present your very interesting report, which we understand is still in process, more to come. Look forward to seeing that. And we wish you well in promoting and gathering interest for some of the ideas and facts that you lay on the table in that report. We certainly think that many of the things that you put in that report resonate with the agenda here, with the interests, priorities of the constituencies here in the ILO, and indeed with a lot of the technical work and research being undertaken in various departments, not least things that matter for changing the gap, the yawning gap between the labor share, as a proportion of national income. So again, thank you very much. Thanks to all colleagues who attended. That's a good decision.